And welcome to the Investor Coaching TV show. I'm Paul Winkler, your host. We talk about the world of money and investing here, and we're going to hit a topic that might be a little sensitive today for your financial advisor. If you've got a financial advisor, a lot of them, you got to look at how they're paid. You know, that's really what it gets down to. People get paid for their work in different ways. In the financial community, the problem in the financial community, let me just say, is that there is really no standard. The industry doesn't really have a great standard as far as, like, if I go to a physician, I know that that physician is competent because they've got doctor in front of their name. Or if I go to an accountant, they'll have CPA after their name or something like that, or, you know, JD for an attorney. The financial industry is really difficult, though, folks, because what happens is that a lot of people don't go for the designations like certified financial planner or chartered financial consultant. And even if they do, a lot of times people don't realize that the education that they have about investment management may be cursory at best. And then the other problem that you run into is, how are they paid? Are there conflicts of interest? Well, that's what today's show is about, conflicts of interest in the investing industry. And specifically what I want to talk about today is start off with fees versus commissions. It's a big debate in the industry. Should your advisor be paid on a fee basis? Or is a commission a better model? You know, some people just absolutely just believe with all their heart that commissions are better, and some people believe that fees are better. And we're going to actually examine both of those things and look at what the differences between those two things are. Now, I was talking to a financial guy. Financial guy calls up and he says, well, you know, I want to argue with it because I tend to go toward the fee-based model, and I'll talk about why in a second. I think that that is a better model to get rid of conflicts of interest, but it doesn't mean that there aren't any. So I'm going to talk about those in just a second. But what this guy was saying is, well, I don't see why I should get paid 10 years from now on something I sold today. Now, clearly, this is a guy that is a commission-based guy, sells investment products and believes that, hey, you know, it's cheaper. You know, pay me the commission up front and then you got a lower management fee and you don't have to pay me ever again. So we're going to talk about that a little bit, what the issues are right there. Now, I'm going to give you some examples of investment products that are typically sold on commission, because a lot of people, let's face it, a lot of people don't even know how they pay their financial advisor. They really don't. Kind of surprising to me, because I'll ask people that, hey, you know, how do you pay your advisor? And they're like, I don't know. I just they have an advisor, they come over and they recommend something, and that's pretty much it. So a lot of people are oblivious to it. Well, what are the different arrangements? Number one, you might have A or B share mutual funds. Now, an A share mutual fund is where I pay a commission to walk in the front door. Let's say that I have $10,000. I might have a 5.75% commission, or $575, that goes to the advisor's broker-dealer, and the broker-dealer pays part of that, or most of that, typically, to the advisor. Now, that's an A share fund. Now, a B share fund, you might put that $10,000 in, but the money doesn't come out visibly. You'll get a statement, and you'll see that, you know, all the money that you put in is still in there. But what they do is they charge a higher management fee. They pay a commission, but what happens is they take that commission out of your account little by little. And if you leave early, they hit you with what's called a back-end surrender penalty. It might be 5%. So if I put $10,000, let's forget about any growth right now to make this really, really simple. I put $10,000 in an A share fund. A share fund, 5.75%, 575 comes out, and then I got 9,425 is what my account value will be, right? And then if I pull that out, that's what I get out. With the B share, I've got $10,000 in there. If I leave it there, that is what grows minus the management fee in the investment going forward. If I pull out early, I have a 5% back-end surrender penalty, or $500. That compensates or reimburses the mutual fund company for the commission paid to the advisor. So those are the two different things. Those are commission-based mutual fund. And sometimes you can have A and B share funds inside, typically A share funds inside of a fee-based account, and there's no commission. You see, so it's not quite as easy. You'll know if you don't have a commission if you're paying a management fee. The second type is you'll have annuities. A lot of annuities, most annuities, a vast majority of them are commission-based. You'll have indexed annuities where literally what they're not technically considered a securities product. They're indexed to like the S&P 500 or the Russell 2000 or the Europe, Australia, Far East Index or something like that. Indexed annuities are, you'll typically hear, You can't lose any money in this investment product, and if the market goes up, you get to participate. I've done entire shows on that topic. If you're curious about them, go look at my archives on paulwinkler.net at the Radio TV tab. Go to Radio TV, paulwinkler.net, and you can look through archives of my past TV shows. Now, variable annuities, where they typically invest in more traditional like mutual funds. They call them sub-accounts. And then you'll have a commission typically with those types of annuity products as well. And then you'll have a fixed annuity. That's something where they put it in investment products or the insurance company portfolio where it's just paid a certain interest rate. There's no variability. It doesn't go up and down with the market or anything like that. Most often, those products are sold based on a commission. Now, there are no-load products in that particular area. Just be aware that that exists. Then you'll have unit investment trust. You know, a lot of times a broker will come to your house or you'll go to their place and what they'll do is they'll say, hey, we got this unit investment trust and invest in small cap stocks and you can buy this and it'll have a certain period of time that it goes for. You pay a commission, it goes for a period of time, and then what happens is now you got to buy a new one because this one has gone through its life cycle and you'll buy a new one. Now you'll have REITs, real estate investment trusts, or a lot of times they're charged on commission, or ETFs, exchange traded funds. Now, you'll have a lot of big brokerage firms that advertise no-load ETFs, no commission ETFs. You know, some areas of the market, they'll actually charge a commission, some not. If you buy it through a broker, typically it's a commission-based product. So a lot of these different things. Commodities. A lot of times what you'll have is you'll buy commodities like gold, silver, or pork bellies or something like that. And what they'll have is a commission-based type of an arrangement where the advisor gets paid something for you buying that product. So those are some of the examples out there that I want you to be aware of. Now, how do most advisors get paid? I mean, really, advisors have these different methods of getting paid. How do they get paid when you walk in to a brokerage firm? What kind of compensation are they going to get? Well, a lot of times you'll have people that are commission only. In other words, that's it. They don't get paid any other way unless you buy something. A lot of times what they're going to do, folks, is this. Free financial plan. We'll do a free financial plan for you and, no obligation whatsoever. And guess what that financial plan is going to be? It's going to be a whole laundry list of stuff that you can buy from who? Them. So commission-based is a very common formula out there used in the investment industry. As a matter of fact, that's how I started. Several years ago, I was in a commission-based type of a firm. You might have somebody that's commission and fees. In other words, they get paid commission. They may charge a fee for the financial plan, and then when you implement it, they get commissions on those product recommendations. Very common one. Or they may go like this. I charge commission for this stuff. I get fees for this. They may have different types of models based on what they're recommending, how they're paid. Then you'll have fee only. Fee only is where you have somebody that they only get paid based on fee, nothing else. They don't get any commissions on any product recommendations. Now, some studies show that 70%, I saw a study, it was actually in the magazine Investment News, that talked about how something like 70%, more than 70% of assets under management were in commission-based accounts. So that's why I'm going to focus the rest of the show. We're going to be talking about commission-based accounts for the rest of the show and talking a little bit about, hey, what's better, fee or commission? What are the issues on both sides of the argument? We're going to do that right after this on the Investor Coaching TV show. Stay tuned.